Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Tuesday, March 2nd, 2021. I'll just take a look at the markets. A couple things that I haven't updated lately, and what I have been updating is the trading range here recently. And you see, I have a couple lines. This is really where we've kind of popped. Originally, I had the line there at the top of the gap. That's the gap down from Monday the 22nd of February down to Tuesday, February 23rd. And that was pretty much what capped this bounce with a little bit of an overshoot each day. And then what happens is once you overshoot, the first day you tested the gap, second day you had a little momentum fueled overshoot, there was a strong rally into it, and that sets a reaction high, and therefore you have at that point, that's the pretty much the resistance if you popped above it, and that has so far contained all the bounces there, as well as yesterday and so far today. So that's the story. We remain in a very relatively tight trading range. I say relatively, it's all compared, to the bigger picture. The trading range itself, from high to low, it's certainly swing tradable, or especially day tradable. If you can catch, the bottom of the range, swing it up to the top, get out. That's about a 4% range. But that's it. So nothing new to report there. And just to kind of recap, it's still, we had a sell signal when we broke down below the primary trend line, and we're still well below it. So nothing on my outlook has changed so far. I will say it's, market's been very resilient. Usually once you break down, kickback rallies are not only they're to be expected. You're always going to have a snapback rally in any correction. But I will say this one so far, the market's been unusually resilient following a breakdown, and you have to, again, give it points for that so far. But unless we make a definitive break above the top of the range or break down below, again, a break below opens the door for what I believe to be a relatively swift move down to 297, whereas an upside break of the range doesn't exactly mean off to the races. It could, but we have a big old gap right there just above in this resistance level right here that comes in around 330 to 331 or so, somewhere in there. And then should that get taken out, you have a back test of the trend line. So that's it. Let's not overthink or overanalyze it. Let's just see what happens here. So far as of today, another run to the top of the range. This is a 1-minute chart, and selling kicked in, but we're up at the top of the range. So hard to say this is anything but bearish at this point in time. And again, the fact that they've defended this level on two different instances without it breaking down, you have to give that right now, very, very near term, to the bulls from preventing that breakdown right there below the, again, that major, what I think is a very important reaction low from the Tuesday, the 21st or 23rd, I'm sorry. Now, so I'll recognize the resiliency of the market, and I'll say that quite a few stocks, particularly the market leaders, are still in nothing but 110% bullish technical postures, such as Microsoft, some others. We did get the breakdowns and the sell signals I was looking for on a couple of them, Apple and Tesla. But again, the market's not going to drop until you see the majority of those market leaders break support, and I've covered those levels quite a bit recently, so we won't go there. Bottom line, it's still anybody's game. Now, I'll tell you where I think we're going to go. I do think we'll ultimately come back down here, and I think next time we get there, we'll bust through the bottom of that range, and then have that what I've been calling for, expecting once we get it, an impulsive drop, some really impulsive selling that should pretty quickly take us down to 297. Again, it's a big if. I use the word if because these are contingencies. I draw these arrows, and they're contingent on each level being broken. In other words, if we run that back down to the bottom of the range, you still need to break that support, and then that triggers the next sell signal or objective entry. But it is an objective short entry here because we're at resistance, and you could have a stop somewhat above that 331-ish level right there. And I think the RR is very nice. Likewise, if you're a bull, go long in the breakout, trail your stops, or set a stop a little bit below the breakout point, meaning the top of this range, If you're, a little bit more of a longer term investor or a swing trader, you could wait for a breakout and then set your stops below the bottom of the trading range. It just wouldn't be objective to go long right now because we're at resistance. TA 101 says if you're bullish and you're looking to go long, you do it in one of two ways. You wait for a breakout above resistance, which would be pretty much today's highs by a good margin, especially a daily close there, or you wait for a pullback to support. Those are your two objective levels for going long. Okay, enough on that. Let's look at a chart. I haven't updated in a little while, but I have in recent months. I've covered it quite a bit, and this is one of several indicators I use. This is what I call my low volume indicator, and for those of you unfamiliar with it, I like to put a 10-day exponential moving average. That's this blue line on top of volume. You can see my volume bars are turned down. If you have them too white, it kind of takes away from the line. I really focus on the 10-day EMA. Why do I do that? Because you can have a one-day spike in volume or one-day drop in volume, and using a moving average, of course, just smooths out everything there. And you can see I have two lines, a yellow and a red line. It's just more of a range really that you come down to, and that is my the sell level. When volume drops to that level after a rally, especially after an extended rally, you hit the red arrow right there, and that was one of the biggest drops in years. That was close to a 20% drop near bear market, or in some sectors in indexes it was. Major indexes, that was the fourth quarter 2018, just averted it. There we actually didn't hit the line, that's why I have a little shaded arrow. We came real close, and it was also on the heels of a major correction. Now if you've just had a huge washout in the market, then you've already had the spike in volume, and that resets everything. This is what I'm talking about. So here's where I'm going. You hit the low volume, and it's not unusual to stay. Sometimes it's a one and done tag like right there, and then as other times, as I mentioned back here, leading up to the drop before the big, what I call the COVID lows, the March lows right there, we had an extended persistent period of low volume right here. So I always say this is not a timing indicator, just like divergences, just like overbought conditions or oversold conditions. What it does, it shows you conditions in the market that typically precede corrections, drops down to that low volume level. You can see each and every arrow, and those are all tradable corrections. They may not look like much on here because you have this 36% drop right there, roughly. I know the S&P fell about 36%. Kind of distorts these drops. These were high single digits to double digit drops. Again, this one was close to 20% or so, and so what I've always said, and I had said recently, the buy trigger really, or the sell trigger, is usually an expansion of volume once you start to move away from that level right there. So you started to move up sharply right here in the beginning of the correction. Right here, same thing. You started to move up. You can see how the volume took off. Here, let me use an arrow tool. So that's what you look for. And then corrections are almost always on higher volume than rallies. You can see the volume bars in the of course the average. So what do we have here? Well, there's where we first hit that level, and I started highlighting it back here all the way back in December, and I said we've come to that level, but we may stay there for a while, and we did until recently. And it's not mere coincidence. This big spike in volume coincides with the sell signals I had in QQQ recently. So by a lot of metrics, a lot of different indicators that I had, the breakdown in QQQ recently was the real deal, and I'm still treating it that way, and that is why to loop back everything back here, why I can sit here and tell you, well, today was bullish, yesterday was bearish, blah, blah, blah. This is why I still favor this scenario, whether we come down from this top right now or a little more upside. I'm still favoring this. I'm still remaining short, still waiting. It's not an all-in short moment. I'm waiting, as I've been saying for a while, to see these recent lows get taken out, and at that point, that will be my. It's not, when I say all in, that does not mean 100% of my portfolio short the equity markets or a basket of individual stocks. I'll still continue to trade diversified, and also all in might be if I decide to go 30, 40, 50% of my money short indexes and individual stocks. That's my full position at the time. So I'm just saying, dry powder. I'm keeping dry powder at this point in time, waiting to see that happen. We've already had enough kickback rallies here that I've added where I wanted to add at the top of this range. I don't add each and every time we get back up there. I just point out for those of you that might agree, have a similar outlook, and if you missed it or you're looking to add on, well, each and every time we get here, I keep mentioning those are objective levels to short, and it's a lot. If it pans out, you short here versus waiting for a break of that level. That's 4% below. Then you wait for a break. You're almost 5% below these levels. So I really like the risk reward of shorting here. And if wrong, again, you have from where we're at right now, the top of that recent range, this top line here. Let me color it up for you so we can really see it there. Make it yellow and make it real fat. There it is. So from there to the top of that gap, if you wanted to give a little room above that gap, you're talking maybe a 2.5%, 3% stop loss to capture what could be from this level about 9%, 8.5%, 9%, potentially all the way down here to that fourth and at this point in time, let's just say final target, and I have to put an asterisk by that. But that's about an 18% drop. Now, what I mean by that is play it tick by tick. If this happens, okay, we get here, and if we break down, what does the S&P 500 look like? What am I seeing in Treasury bonds? What am I seeing in the sectors within the S&P 500? What am I seeing with the market-leading stocks? So a lot goes into that how we look if and when we get this sell signal, whether I will then favor move beyond 297 or that would be it for the correction. So I'll be talking about it if and when we get that breakdown, that next sell signal. And if we come up here, then I'll be talking about, okay, well, look, pretty bullish. They took out the trading range. They backfill that gap and take it out. Well, that's going to open a door for a back test. And how does that look if we start to move up there? What is the S&P 500 looking like? What are the different sectors looking like? And if so, I'll make a determination whether this is it for the correction, just like we've had some little relatively small corrections along the way, or no, looks like we're going to back test and then move lower. So again, let's just focus right now in the very near term what happens here in this range, or if we pop above there, what happens when we backfill that gap. All right, to wrap the video up, I want to do I like to do this from time to time, look at the 11 sectors in the S&P 500. As we're going through these, keep this in mind. We're going to look at two time frames, daily charts and weekly charts. There's 11 sectors. I might even skip out on the bottom ones because their weighting is so small, it doesn't matter. When you get down to the REITs, XLRE, the real estate investment trust, basic materials, they can go gangbusters. They can rally 20, 30%. They're hardly going to move the needle. Why? Because of the weighting. I haven't updated these numbers in a couple months, but they don't change too much. But this is the XLK, the technology sector ETF. Technology is over a 25% weighting in the S&P 500, by far the largest. And so this is it. When you want to look at just one sector, we can do that. And where this sector goes, this is the market. Tech has been the market, not just for the past few months. Tech has been the market for decades now. I'm talking about Apple. I'm talking about Microsoft. Big tech. Due to their weightings in the indexes, their growth rate. That's where the fastest growth rate. I mean, tech's growing a lot faster than telecom or. Well, that's the old telecom. They eliminated the telecom sector and replaced it with communications. But we'll get to that. All right. So let's just keep it simple. Tech has broken down. And if this looks familiar, it's an almost mirror image of the Nasdaq 100, which happens to be over 50% technology stocks. So XLK and QQQ really are very, very similar charts because they have very, very similar weightings and top heavy weightings. Well, this is all tech, and Nasdaq 100 does have some different stuff there. But that's it. You had a divergent high right here. There's your divergent high, as pointed out. There's your nice cleanup trend line off the March lows. Enough reactions to make it valid. A little whipsaw there. I talked about it at the time. why we got it and why it proved to be a whipsaw. Then the pulsar breakdown, and then you zoom in nice and tight, and just like QQQ, which I'm really hyper focused on now. Yeah, it's not the entire market. We'll get to that in a second. But there it is. There's our recent trading range, playing a game of ping pong between the recent highs and lows. And I look at the chart. PPO's turning up above the zero line, so the case can certainly be made that this is a just a breakdown, and it was a correction. From the highs. It's not like we didn't get a correction. It's about 7.5%, 8% so far off the divergent high. But the $1 million question, is that it, or is this the beginning of a much deeper correction? And then you can see some potential targets. Don't pay attention to all these lines. I would say right now, let's just say this would be, should we break the recent lows, I'll tell you that'd be my preferred swing target down there at about 110.71 in XLK. All right, moving on, because that is the majority of the market, or the bulk of biggest weighted index, I should say, but it's not the entire market. Next up, you have XLV. Again, these numbers may have changed slightly, but this is the second largest index, or sector, I'm sorry, within the S&P 500, and that's about almost a 16% weighting. Here's my trend lines. That's our uptrend line. We've been building divergence for a while, including this little divergent high on the RSI right there. We broke down, back tested, and we've been dancing on this support about 113.83, give or take. We had one little intraday whip through there, so that's pretty much it. If we take out the recent lows in this one, that should open the door down here to move of 109.61. And again, I say this because at a nearly 16% weighting, what happens in the healthcare sector does impact the broad market. I'm talking about the S&P 500. Okay, so that's the chart there. Oh, I got to loop back because I forgot to show you the weeklies. Weekly chart, XLK. All right, this is, it's again, helps formulate, my opinion on even on where we're going in the near term on the daily chart. When I look at this, I'm zooming back. We're going all the way back to 2009. So this encompasses the entire bull market. Make no mistake about it. Tech has been in a larger bull market, and there's your uptrend line. It's a nice clean uptrend line. So one day in the future, whether it's the near future or distant future, this is a trend line that's very, very significant. Lots of reactions. That comes off the 2009 lows. One of the most powerful bull markets in history, a la the Fed and other central banks, flooding the system with cheap money and excess of money. And that's it. Now, okay, why is that significant? Now we're nowhere near it, but it is a magnet for pullbacks and corrections. Every now and then when you set up a primary trend line, you come back and visit that trend line. You get too far away from it, just like a moving average. You get too far away from a key moving average, typically you're going to come back and visit it every so often. So it is a potential swing target. It's a big one. And again, we'll see. We're going to take it day by day on the daily charts, but I'll keep an eye on this weekly chart. And when we zoom in here, or no, let's stay zoomed out. Here's the common theme here. We have, I don't know why, sometimes these lines just seem to disappear. We have, this was the last bull market that ended in October 2007. And I just want to show you, common theme here. That's a divergent high, negative divergence. That's a 55 or so % drop right there. At least in the S&P 500 it was. XLK is similar. This was a divergent high. That is a double-digit drop. That's a drop that lasted, months, probably 6 months or more, and was double digits. It may not look like it again because we're going over such a long time period, and I use log scaling. If you don't use log scaling on such a long period of time, you get a distorted picture. That's what XLK looks like without log scaling. So make sure you're using log scaling when you're looking at something that's gone up on the time frame or the scale, the chart you're looking at. When you have a security that went from 13 to 133, it is imperative to use log scaling. Okay, so fast forward. Other than that, just keep in mind, boom, these are all the big drops. That was a huge drop right there in XLK off the highs. That was about a 28% drop. Here's a drop that measures. Have to cut over here to do it, and that was about 25%. And see the common theme here, it's not just the divergent highs. You want to look for that, but then your sell signal comes on a trend line break. So I look for divergences which can build, 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 build. They can keep going, going, going. Sometimes they get burned out or negated, but if they don't and you get a sell signal like this, that's your moment to get out of your longs into short and capture these corrections. There's a trend line break, correction. Trend line break, correction. That was a big drop in the March lows. Trend line break, correction. Wasn't huge, but it was tradable, and I'll measure it out for you. It was from the point we broke the trend line, it was a drop about 5%. But now we have a sell signal, as you can see, right along with QQQ. Last week, solid weekly close below that trend line, and that puts us on a sell signal, especially with this big divergent high right there. All right, so that's XLK. Now I'll move a little faster. I'll go through the rest of the sectors. XLV I already showed you on the daily chart, but what do we have in common with a lot of sectors right now? This divergent high, 27% drop. Divergent high, I didn't measure it out there, but it's double digits. Divergent high, same thing. I didn't measure it out, but that's probably 25, 30% or more. And that divergence continues to build. That was a small, really small divergent high back then. This line here, that was just a back test of the trend line. Here's what you're looking at. You know, there's so much on these charts. This is your primary trend line right here. It was broken at this point and then back tested right before the drop into the March lows last year, and continues another back test there. So what I did is I set up a secondary, a benefit of the doubt, BOD trend line right here. What would stand out right now is this divergence that has been building since we had that small divergent high that was the technical catalyst. And the fundamental catalyst was COVID back then and that drop. But the technical catalyst that priced in a reversal was the negative divergence and overbought conditions. This is the RSI. Red line says you're overbought. And typically you get bigger drops once you become overbought like this and then become less overbought. That's what gives you negative divergence. So we have a much bigger divergent high, potential for a much bigger drop. I know there are a lot of people, if you're still listening to my voice, a lot of people probably have given up because this market just doesn't seem to go down. But these technicals take months to play out quite often when you have these overbought or divergences, overbought condition, excessive bullish sentiment. And the one thing that I can promise you is that if these big divergences play out for a big drop, we're talking 20, 30% or more, what will happen, and this is how it works, the news flow will change. I know right now the news flow couldn't be any more bullish. You have vaccines that they say are working better than expected. You have a Fed that I think is almost criminally negligent in their outlook right now, and their pledge to keep rates low and saying inflation's not at risk. I'm continuing my long-term, positions, core stuff that I'm, trend trading are commodities, and they continue to rip. And that's going to continue to happen right now. There's an inflation trade. Everybody but the Fed seems to see it. Institutions are seeing it. You pick your commodities, whether agricultural, industrial metals, oil, they're all ripping. And that is also reflected in long-term bond yields, et cetera, et cetera, et cetera. Okay, I got a little off task there, but what I'm trying to say is what will happen is right now the news flow and the fundamental backdrop and a super easy, the most dovish Fed that I've ever seen, coupled with improving economic indicators. There's a lot of these employment claim, new home starts, things like that, housing prices. It seems that fundamentally we have a great backdrop, and I can certainly see the case for a very strong 2021 based on that. However, if these technicals, which I put a higher weighting into, play out, because the market is forward-looking. So everything I just mentioned, the dovish Fed, the improving macro fundamentals overall, low inflation, how much of that's been priced into what's already happened? So if this scenario starts to play out, if we break this trend line, if we come back down here, let's say to that target, I'd give you another target. And this is just one sector. I got a little bit of a tangent, but it all ties into the big picture. Then $95, that would be the first target if this trend line goes. on the healthcare sector, XLV, and that would be a drop of about 16, 17%. If that happens, after it's when, and it may have, in this case it may have already started, has already started, let's say we're going to do that, but what happens is the headlines, the news flow will begin to change, whether it is the Fed backing off their uber dovish stance, saying, well, okay, maybe inflation is a risk, or whatever they want to say, tapering off bond purchases. They'll do it subtly. They have no choice but to backpedal slowly if and when they finally do, or when they finally do that. And then same thing with the economic, indicators. Watch for the reports. Look for the CPI. Look for all the stuff coming out, industrial production, things like that. Okay, so I didn't mean to go off on too much of a tangent, but again, it all explains how that can play out in such a strong market because things change, and they can actually change pretty quickly, as I said, both technically and fundamentally. All right, XLV, we're moving on. That was a long-term outlook. Financials all been on fire lately. Why? Well, because you have the most dovish Fed, who has pinned rates to zero or near zero, flooding the system with liquidity. Yet, everything that I've been talking about, inflation ripping, commodity prices ripping, home prices ripping, the stock market, which is an asset bubble, ripping, from off the March lows, all inflationary factors. And so what that's done is it's caused long-term bond yields to go up, and that's caused the yield curve to go up. So you have down here zero, low, near zero interest rates, and you're seeing longer-term yields ticking up. This is what makes banks profitable. They take in your deposits, pay you next to nothing on your checking, savings, and money market, and they're turning around and making car loans, boat loans, home equity loans, mortgages, business loans at a much higher rate. So that's called the spread, and that's why banks have been doing well. What would check that? Well, I showed you long-term Treasury bond yields recently hit major resistance, had a pretty sharp reaction. So if long-term yields start going down, and even worse, if the Fed starts to backpedal or ease off their uber dovish stance, either or, a combination of rising short-term rates or falling long-term, especially in the mid part of the yield curve as well, that would certainly impact the financials from a fundamental perspective. Now, that's fundamentals. Sometimes doesn't matter. Technically, somebody asked a few weeks ago, and I think I covered this in a video, what's your outlook on XLF? Well, we have this nice, clean, well-defined uptrend line right there. Well-defined because 1, 2, 3, 4, 5, multiple reactions. And what I said, I posted this chart, said a break of this would likely bring us for a back test. This was a key breakout level, about 31.35. We had that sell signal right here. That came on Friday when I was away from my desk. Breakdown, and so far we back tested it yesterday, and we're right about there. So there's a breakdown and a back test, and that puts XLF on a sell signal, despite being right off all-time highs, having just broken out. But we have negative divergence, which leads me to believe this will play out for at least a drop down. Why is that a big level, 31.35? As I roll back here, you can see, oh, here we go, turn off all the lines. It was just these, previous highs right here, and that's where financials fell down hard. So there's another one, XLF, that near term has just triggered a sell signal. Longer term, it's bullish. Look, I can be near term bearish on something, in other words, call for a pullback here to 31.35, which would simply be a back test of the breakout. And should that hold, should everything look good at the time, that would could be the most objective entry before the next leg up on the road to new highs in the financials. So we'll see where that goes. There's the weekly chart, what it looks like. All right, so we'll go through a few more. I don't have to hit on them all. XLC, communication sector, fourth largest sector. It has about a 10.6% weighting. Again, probably updated these last quarter, fourth quarter of 2019, 2020, I'm sorry. And pretty heavy weighting in right here in some of these FANGs. Facebook's about 21%. Alphabet collectively is about 22, 23%. And so just those two companies alone make up almost half of XLC. So you can see again why my hyper focus on the FANG stocks. It doesn't matter where the rest of the market goes. Doesn't matter how strong the fundamentals are on the 495 other companies in the S&P 500. When these top five, or now I call six, I'm adding Tesla in there just because of its weighting, when they break because of their extremely heavy top weighting in the indexes, particularly QQQ, but also in the S&P 500, a higher weighting, they'll bring the market down with it. So anyway, that's our trend, my trend line. Not super well defined. Enough reactions. One down here at the March lows, couple reactions there. Big wedge on a weekly chart. It hasn't been around long enough. XLC, it used to be the telecom sector, and then back in 2018, they 86 the telecom sector and replaced it with this new sector called communications and changed some of the components around. XLY, the trend line I have, I'm not using off the March lows. I think this is a cleaner trend line because we have more reactions. I always say trend line drawing is subjective, but this is the one I like to use because we have a lot of reactions, and so I have it breaking down recently. But look, it broke down, and that's not, it is a near-term sell signal, but this is a big level. This was a breakout about 156.26, so that would be a near-term target. Now, if that breaks, it opens the door to a much larger correction. So these are the things I'm looking for in the coming weeks. And again, maybe this was just a little, correction, and we regain these trend lines. That's something else. That would be bullish. Move back above this trend line. It would be hard to spin as anything but bullish, in my opinion. XLI, negative divergence, pretty good breakout. So here's a common theme. A lot of sectors have recently broken out, financials and this one, industrials, and some of the others I covered. There was a major reaction high, fell down into the March lows, rallied back up, gapped above it, held 1, 2, 3 successful tests, and we came and back tested it again. That we could be off to the races here. That is possible. However, we have negative divergence right there, and we've had divergence building. So this sets the stage for potential failed breakout. Maybe another back test, but if we fail below that level there, 84.42, especially being that we've already successfully tested it, that would be bearish. So there's a big level right there. And again, if you're bullish but maybe near-term bearish, you can, if you get a pullback to that 84.42 level, look, that's about as objective as you get for going long. If you think we're going to have a blowout year in 2021, if we even get that. So we'll see if and when we get there, and that's about it. One last I'll cover because it's a decent weighting, about 8%. XLP, consumer staples. That one's rolled over. That one topped back here. There's that little doji candlestick right there back on November 16th. And it's been gradually moving lower. Nothing big, but it's been moving lower since. And I see, first decent support comes in here around 61.70. Oh, I'll do one more just because I've talked about it recently. Energy. You guys know my thoughts on that. I posted updates quite a bit recently. That's a big level right here, really big level if we get up there, 53.61. But we already have some of the others, XOP, XES. We have we recently had a sell signal on crude on that 60-minute chart, CL, and we haven't yet hit my final target. Here, I'll show you that. This is it. We had sell signal on the break of this minor trend line. When it hit my first target, bounced as expected. That's the initial tag of that trend line where reaction was likely. Then we broke it, triggering the second sell signal. Little kickback rally, and I think we come down here at minimum to 58.90. Should that break, whether we have a reaction first or not, and I do expect a reaction, but whether we get that or not, if we break it, that would open the door for a much larger move, probably all the way down here at about the 54 level in crude. And so that would certainly impact this, and that would likely take us below this uptrend line right here. There's the uptrend line on XLE. So this is the trend line to watch. In fact, I'm going to set an alert, and should that trend line break, well, these are all potential pullback targets. Okay, that's it. There's I'll skip utilities, REITs, and basic materials because again their weightings are so small. It's not going to move the needle. 3.5% on utilities, 3% on REITs, and a 2.44% weighting in basic materials. So I'm not going to talk on the charts. I gave you my thoughts, and I threw in a lot of kind of fundamental variables or things to look for there in the market as well. And as well as certain sectors like the financials. All right, let's wrap it up here. I'll get it out to you guys, and updates will be commensurate with any new developments in the market. It's just kind of I'm getting repetitive recently talking about this trading range. This is a little game of ping pong in the Qs, wash, rinse, repeat, and we'll see where we go from here. This has been Randy Finney with Right Side of the Chart. Have a great day.